Welcome to today's market report.
Soaring energy prices retreated and stocks on Wall Street rebounded on Wednesday after the top U.S. Senate Republican backed an extension of the U.S. debt ceiling and Russia calmed volatile natural gas markets in Europe. The unrelated moves eased growing angst amongst investors about a possible historic default on U.S. government debt and surging Dutch wholesale gas prices. The European benchmark that had jumped eightfold this year to record highs. U.S. natural gas futures plunged more than 10% a day after they soared to a 12-year high. Yields on 1-month Treasury bills tumbled after Senate Minority Leader Mitch McConnell said his party would support an extension of the federal debt ceiling into December. Republicans had been expected on Wednesday to block a third attempt by Senate Democrats to raise the $28.4 trillion federal debt ceiling. There was a lot of nervousness that time was running out on debt ceiling talks, according to a lender, but primary catalyst for the day's volatile market moves were the Russian decisions on natural gas. The global energy crisis was becoming a focal point for inflation concerns. Earlier, a strong private payrolls report helped boost expectations that U.S. Federal Reserve would soon taper its massive bond purchases. U.S. private payrolls increased by 568,000 jobs in September as COVID-19 infections subsided, or 140,000 more than economists polled by Reuters had forecast, according to the employment report from ADP that pointed to a recovering job markets. Unless Friday's non-farm payroll report is a disaster, a taper announcement by the Fed in November can be expected with its quantitative easing program over by mid-2022, according to InspirX. QE buying right now at a full bore at worst is limited or has no effect. According to them, they are going to have a raise interest rates in 2022. MSCI's all-country world index paired losses of more than 1% to close almost flat, down 0.1%, while the broad Euro Stoxx 600 index in Europe closed down 1.03%. On Wall Street, the Dow Jones rose 0.3%, the S&P gained 0.41%, and the Nasdaq added 0.47%. In Europe, Eurozone yields rose as a government bond sell-off extended on inflation concerns and potential monetary policy tightening. A gauge of German inflation expectations hit its highest since May 2013. Germany's 10-year government bond yield, the benchmark of the Eurozone, rose as much as 4 basis points and hit its highest since the end of June at minus 0.147%. Yields on the US Treasury 10-year benchmark fell from more than 3-month peaks, but the outlook for rates remained tilted to the upside. The 10-year notes yield fell 0.7 basis points to 1.5241%. The dollar rose towards the 1-year high touched last week as inflation concerns fueled by surging energy prices and the outlook for rising rates knocked investors' appetite for riskier assets. The dollar index rose 0.22% to 94.219. The euro was down 0.34% at $1.1557. Dollar yen traded down 0.04% at 111.4. The New Zealand dollar earlier extended losses after barely budging the Reserve Bank of New Zealand, lifting its official cash rate for the first time in 7 years. Oil prices dropped nearly 2% after hitting multi-year highs, a step back from recent torrid gains after U.S. crude inventories rose unexpectedly. Brent crude fuels fell 1.79% to settle at $81.08 per barrel. Crude settled down 1.9% to $77.43 per barrel. Gold futures settled up 0.1% at $1,761.80 per ounce. GBP/USD extended a recent rebound from the weekly bottom towards the 136 threshold, near 135.90 towards the end of Wednesday. In doing so, the cable pair again bounced off 23.6% Fibonacci retracement of September 14th to 29th downside, actually before that, while the latest recovery moves aim for the 136 round figure, a convergence of 100 EMA and a descending trend line from September the 17th near 136.35 joins the bearish MACD signals to challenge the pair's further advances. The next resistance is at 137.20.
This is today's market news. Thanks for listening. We'll see you next time.